Hello students, I welcome you all to this new and beautiful week. As you know that this is our 10th week. This is our 10th week, and having exhausted all the topics we have in our scheme for this term, we'll use this week and do revision on few of the topics which we have treated this term. Alright, we'll be revising balance sheet and control account. If you remember, these two topics are the last topic that we treated, the balance sheet and then the control account. We'll start by explaining the meaning of balance sheet one more time. We say that balance sheet can be defined as a statement that shows the presentation of the summary of the asset and liability in a well-arranged form. It's a statement that shows the presentation of the asset will be on the credit side, the liability will be on the debit side in a well-arranged form. The transactions will be well-arranged and clear that even a layman can read and understand. Is that clear? We equally said that it shows the financial position. The reason why we prepare this balance sheet is due to the fact that it shows the position of the business financially. It makes us understand the clear position of the business. We were able to ascertain if the business is making a profit, if the business is losing money. So with this balance sheet, you will be able to discover that. Is that clear? Now the next one is type of assets. Types of assets. We listed many types of assets. We talked about fixed assets. We say that fixed assets are those assets which are permanent in nature. They are permanent in nature. They last for more than for a period of 12 months plus, more than 12 months. That is more than 1 year. Any asset that lasts for more than 1 year, we call it fixed asset. That's the first one. In types of assets. Then in types of assets, we equally have current assets. Current assets, these are assets that can last for a short period of time. Fixed assets can last for more than 1 year. Current assets can just last for 12 months, that is 1 year. And then we have example of such as cash in hand, stock of goods, cash at bank, prepaid expenses, prepaid expenses, stocks, we say stock, prepayment. Do you understand? And then example of those of the fixed assets we mentioned earlier. Example, we have land, we have building, we have plants and machineries, we have furniture. You can list them. Machineries, generator, building, all these things. All right. Now the next one we have here is fictitious assets. It's still a type of asset. Fictitious assets. They are merely debit balances, not written off. Example of this is preliminary expenses. Now we have another one we call intangible assets. Intangible. They are assets that cannot be seen or touched, although they have value. But you can't see them, you can't touch them, but they are assets. All right. We have example like we have goodwill, we have patent, we have copyright. Just like I explained the last time, we have a franchise, etc. These are examples of intangible assets. Those assets that you cannot touch, you cannot see, but they exist. Exactly. All right. The next one we'll have liquid assets. These are assets that can be easily turned into cash. The assets that you can easily turn them into cash. We have your debtors. We have an investment. You can easily sell off whatever you invested, and then you do that. Now we have wasting assets, etc. Now we'll move to the next one, which is types of liabilities. Types of liabilities. Remember, we say that the balance sheet is made up of is a statement whereby we arrange our assets and our liabilities in a well-arranged form. Now we've talked about assets. Here we're going to talk about liabilities. What the business is owing the world. Do you understand? Liabilities, what you owe the world as a businessman. All right. So we have long-term liabilities and current liabilities. So you can say current liabilities. You can call it short-term liabilities, because they are those liabilities that will not last for a long time. Within a year, you've paid it off. You've paid the money which you're owing the outside. And then we have long-term liability. These are obligations expected to be paid after 1 year. It can even take 5 years. Can even take 10 years. Do you understand? All right. Now let's keep moving on. The next one we have capital. Well, let's define capital. Capital is the owner's interest in the assets of the business. Capital is the money you use in starting up that your business. What you have, the worth of that business when the business was starting. That is capital. Now, what is working capital? Working capital is the excess of current assets over the current liabilities. Remember, we listed the current asset. We said debtors, stock, cash at hand, cash in the bank, prepayment, etc. And then current liabilities, you can see examples of current liabilities. We have creditors, accruals, etc. All these ones are current liabilities. So the excess of current liabilities over the current, the excess of current assets over current liabilities is what we call working capital. You understand? Now, capital employed. This is total asset less current liabilities. When you add up both the fixed asset, fictitious asset, wasting asset, tangible asset, current asset, you add up all the assets minus current liabilities. You get what we call capital employed. Is that clear? Now let's talk about overtrading. Overtrading, like I explained the last time, overtrading is a situation where a firm has no working capital. You have no working capital, that you are busy buying products, keeping them. You'll be packing products in your shop. You have goods in your warehouse. You have goods in your shop. You buy in large quantity, but you sell in small quantity. That is what we call overtrading. It's very, very wrong in a business. You don't just buy and buy and buy. You wait for a while. You make sure that your goods, you are about to exhaust all the goods, all the stock you have. Then you go to market again and then restock your business. Is that clear? Okay, now let's go back to control account. That is the last topic we did. Control account. Control account. I told us that in big organizations that many ledgers are kept for debtors and creditors. In big organizations, they have so many things to do. They have so many things to record. They have a lot of transactions going on. Debtors will be coming, creditors will be coming, returns will be coming, return outwards will be coming, return inwards. So now they devise a means to make work easy for them, and that is what brought us into this control account. Control account can be said to be the memorandum account. Is that clear? Control account is a summary account in the general ledger. To summarize, you bring the debtors together, you bring the creditors together. The summary account in the general ledger. The details that support the balance in the summary account are contained in a subsidiary ledger. Hope you still remember when we talked about subsidiary books. All right, let's move on. We have division of control account. The control account is divided into two. We have sales ledger control account and we have purchases ledger control account. Sales ledger control account, and we have what? Purchases ledger control account. Now, sales ledger control account is the control account for the sales ledger. Is the book where we record everything that pertains sales. Now, when we talk about sales, we talk about things sales and then the things that comes with sales. Like when you sell goods, goods can be returned. So returning worth is equally moving hand in hand with sales. There are still other things in selling. You can equally decide to give discounts. So sometimes discount goes with it. Do you understand? Discount can equally give discount to your customers. Do you understand? It can go with sales. So all those things that consigns sales, you record it in the sales ledger control account. In the book we call such ledger. Then for purchases ledger, everything that consigns purchases. You purchase goods. Remember, you can equally return goods after purchasing them. due to let's say you don't like the goods anymore, what you ordered for was not what was sent to you, the color you asked for was not what you saw in the pack, so you can just damages and other things, and you can decide to return them. So those things are the things you return, you record in the purchases ledger control account. Remember I said purchases ledger control account can equally be called total creditors control account, while sales ledger control account can equally be called total debtors control account. Total debtors control account. Total debtors is for sales. Total creditors is for purchases. Hope that is clear. Alright, we have advantages of control accounts. Why are we keeping control accounts? Why don't we just bring one book and start recording everything? One of the advantages it says that it controls control account helps in locating errors. It helps us to locate errors. You know, when there is an error, you'll be able to get the book for debtors, get the book for creditors. You have everything well arranged, and then it's easy for you to do what? To discover where the error is coming from. Exactly. It helps us to locate error. It can provide a check on the accuracy of balances of the ledger. Yes, you can check the accuracy of the balances. The sales ledger, purchases ledger, return invoice ledger. It helps us to check them, to know what is going on there. Fraud will become very difficult. Fraud will become difficult. The balances of the total creditors and creditors can be easily calculated. You can easily calculate the balance of the total ledger, and then the total debtors, and then total creditors. They can be used to detect missing figures. You can use the record to detect the missing figures. They save time. Exactly. They save you the time of going to, okay, now this is the month of June, and then you have to look for something that happened in the month of January. You start searching. But if you have different books, you just ask the person what happened. Was it sales? Was it purchases? Was it returns? With that information, you can go straight to the book that belongs to sales, the one that belongs to purchases, and you pick what you want with the date intact. You will be able, just once you open 1, 2, 3, you are there. You get the information. It makes work. It saves time. Time of going to cross-check. Oh, January 1st. Oh, this thing. Is this? I don't even know what happened. Once you know the full information, the details, you can just get the book and then get it straight. Do you understand? Alright, please, I will advise you read up, go back to the content of the balance sheet, go back to the content of control account, and then read in preparation of the CAS 2 that is coming up by next week. Thank you very much, and God bless you.